Hello everyone, welcome to Dikshant classes. Today I am going to continue the accounting conventions, which are basically conservatism, full disclosure, materiality and consistency. Let us continue the accounting conventions. Accounting conventions are the guidelines which used by the enterprises, company to determine how to record business transactions, not yet fully covered by accounting standards. They are generally accepted by the accounting bodies like Institute of Chartered Accountants of India, but are not legally binding. There are four widely recognized accounting conventions. These are conservatism, consistency, full disclosure, and materiality. Accounting conventions are bear the practical considerations in the recording the transaction of the business enterprises in the systematic manner. Convention of consistency, convention of conservatism, convention of full disclosure, and convention of materiality. First is accounting convention. Accounting convention, as it is a name suggested that are the practices adopted by the enterprises over the period of the time and that rely on the general agreement between the accounting bodies and help in assisting the accountant at the time of preparation of financial statement of a company. For the purpose of improve the quality of financial information, the accounting bodies of the world may modify or change any accounting convention. The first convention is consistency. Financial statements can be compared only when the accounting policies are followed consistently by the firm over the period. It means that if you want to compare the financial statements of one company for a two period, for example, first April to 2025 to 31st March 2026 and 1st April 2024 to 31st March 2025. We can compare it when we have the proper data of that particular time, and it can be compared only when the accounting policies are properly followed consistently by the firm over the period. Next is disclosure. The principle states that the financial statement should be prepared in such a way that it fairly disclose all the material information that is important to the users and sensitive to the users, stakeholders, so as to help in taking the financial decisions of the firm, take a rational decision. Next is conservatism. This convention states that firms should not anticipate income and gains in advance, but provide all the expenses and losses anticipate in advance. But when he is not getting any profit or gain income, then how should the company should anticipate? But anticipate the expenses and losses. Next is materiality. This concept is an exception to the disclosures, full disclosures convention. We state that only those items which disclose in the financial statement which has a significant economic effect. Next is first is convention of consistency. The nature of recording the business transactions should not be changed at any cost or moment. It should be maintained through the life period of the firm. If a firm follow the straight line method of depreciation, then he should follow the straight line method only, and he should not allow to follow the diminishing methods. The change cannot be entertained. If the change has been incorporated, the valid reason should be for the change should be emphasized. Next is according to the E.L. Kohler analysis consistency into three types. First is vertical consistency, one time two statement, where the same principle, methods, practices are adopted within the interrelated financial statements of the same date. Next is horizontal consistency. It helps to make a proper comparisons of the operation of a company from one period to another. Next is third dimensional. It helps to make a proper comparison of the operation between two firms within the same industry, Reliance Industry and Indian Oil Industries. So we have compared the two firms within the same industry. Next is difference between consistency principle, pros and cons. First, consistency pros is easy in audit and accounts. It should be easy to audit the account, where should be lacking and what should be benefit lost and where it should improve. Then next is ease for management. It is easy for management to check the fault and to check the efficiency, effectiveness of the firm. Like reduce the cost of training through the consistent principle. Everybody know the how should manufacture the product and it should help to reduce the cost of training. Next is cons. Restrict to the follow the same accounting policy only and assumptions. It restrict to the firm to follow the same accounting policies and assumptions. Next is judgment error. Sometimes there may be judgment errors and changes are permitted. Next is convention of conservatism. The conservatism would not give any emphasis on the anticipation of the firms. It gives the paramount importance to all possible eventualities of the firm without considering the future profit. It means that the conservatism convention has given emphasis on anticipation of the firm instead of give paramount importance to all the possible eventualities of the firm without considering the future profit. The most important rule of the guidance now value of the stock as follows. Stock of the goods should be valued either the market price or cost, whichever is lower, to anticipate the future losses due to default in the payment of stock. It means that the value of the stock should be valued at either the market price or cost, whichever is the lost and lower, to anticipate the future losses due to default in the payment of the customer. This provision is created for bad and doubtful debts of the firm in order to meet the losses and accepted out of the defaulter. According to the convention, the entire status of the firm should be highlighted and presented in detail without hiding anything, which has to furnish the required information to the various parties involved in the process of the firm. Next is convention of disclosure. The convention of disclosure requires that all materials and relevant facts which are important, which are sensitive in nature, considering the financial statement, should be fully disclosed. Adequate means sufficient set of information to be provided to the stakeholder. Fair indicate as equitable treatments of users. Full refers to means complete and detailed presentation of information in depth. Let us take example of business. The business provides financial information to all the interested parties like vendor, lender, creditor, shareholder. The shareholder would like to know profitability of the firm, while the creditor would like to know the solvency of the business. In the same way, other parties will be interested in the financial information according to their objective. This is possible if financial statement disclose all the relevant information in full, fair and adequate manner. If the financial information is complete, then only it is possible for the different parties to use that information in the required manner. Similarly, if there is change in accounting method of providing depreciation on fixed assets or in the method of valuation of stocks or making provision for doubtful debts, these should be clearly shown in the balance sheet of the way of notes. In short, we can say that all the important facts are to be fully disclosed. If they are not fully disclosed, it creates a problem, and otherwise financial statement would be incomplete, unreliable and misleading, inaccurate, and it is not fairly treatment, not transparent. Next is convention of materiality. The convention of materiality states that if any important information which affect the stakeholders or the any other like lender, creditors, the bankers, then should be included in the financial statement. Only material fact, important and relevant information should be supplied to the users of the accounting information. The question that arises here is what's a material fact? Information is materials. If it is omissions or misstatement, it could influence the economic decisions of users taken on the basis of financial statement. Materiality depends on the size of the firms, on the error judges in the particular circumstances of omission or misstatement. Does materiality provided the thresholds or cut-off point rather than the being a primary qualitative characteristics of the information? It provides a cut-off point threshold to point to rather being a primary qualitative characteristics and information must be useful, accurate, reliable. For example, a business start a textile mill. Take only 2 items, weaving machines and bulbs for lighting in the office. He will purchase these items for his business. From the accounting point of view, weaving machine is more important than bulbs. Therefore, distributing the cost of machine over various years is important, but it's not so important to distribute the cost of bulb. If an accountant start keeping the details of each bulb, then his work will be unduly burdened. With every small detail, it is also not useful for the businessman to know every small detail, since it does not affect the financial position in any significant manner. Let us continue materiality. This accounting concept states that firm can ignore small information which does not have any significant impact on the business and stakeholder. Degree of the significance depends on the user of the financial statement. It is relative in nature, can be material to one company and immaterial to another company. Abuse of materiality. Abuse of material concepts can have the serious legal implications for the businesses considered for the abuse includes the intent behind errors and effect on error user judgment. Next is significance of materiality. Materiality impact the reliability. Materiality impact Materiality impact relevance. Next is audience of materiality. Shareholder and investors, lenders and bond raters, parties to merger and acquisition. Next is measurement. Generally accepted accounting principle and financial accounting standard board have not clearly stated that what qualify as material information and however they have provide few rules to determine materiality. Error of 0.5% of the sales revenues or 5% or more of the net income before tax. An entry of more than 1% of total equities or 0.3% or more of total assets comes under the measurements. That's all today's class. If you have any doubts, any query, you can put in the comment section. I will surely make videos. Thank you so much for listening carefully.